Today under financial statement analysis, today I'm going to discuss about return on equity. So how do you calculate return on equity? So return on equity measures basically a company's profitability in relation to shareholders' equity. So the return on equity is the measure of company's annual return, which is the net income, divided by the value of its total shareholders' equity expressed as a percentage. So therefore, by comparing companies' return on equity to the industry average, something may be pinpointed about the company's competitive advantage. So ROE or return on equity may also provide insight into how the company management is using financing from equity to grow the business. So a sustainable and increasing ROE over time can mean a company is good at generating shareholders value because it knows how to reinvest its earning wisely so as to increase the productivity and profits. In contrast, a declining ROE can mean that the management is making poor decisions on receiving capital in unproductive assets. So in order to calculate ROE, so we need to take profit after tax and preference dividend. If the preference share capital is there, so we need to deduct the preference dividend, then you take the profit after tax and preference dividend divided by equity shareholders fund times 100. So thereby you can calculate return on equity. Now let's move on to this particular question. Now you are given the income statement for the year ended 31st December 2020, and also you are given the financial position as at 31st December 2020. Based on this income statement and financial position, we need to identify return on equity. Okay, so first and foremost, you need to identify the profit after tax and preference dividend. So that amount will be from the income statement, that is a profit for the year 325,800, which is after deducting interest and income tax. So in this scenario, the preference dividend is not given, so therefore we don't need to consider about that. So profit for the year is 325,800. Then what is the shareholders' equity? The shareholders' equity consists of equity plus retained earnings, which is 970,000. So to calculate the return on equity, so what you should do, profit after tax and preference dividend divided by equity shareholders fund times 100. So we calculated the profit after tax as 325,800, it is already given, divided by equity shareholders fund, which is 970,000 times 100. So that will give you 36%. Okay, so this is how you calculate return on equity.